For the modern entrepreneur, the world is a buffet of countries, time zones, and lifestyle upgrades. The rise of digital nomad visas has fueled a seductive narrative that simply by moving every few months, you can effectively decouple yourself from the high tax burdens of your home country. You see it in every zero competitor keyword search and every travel forum. People are looking for the secret digital nomad tax rate. But here is the cold reality that most lifestyle influencers ignore. A digital nomad is a travel category, not a tax category. While you might be a nomad in your own mind, of course, the global tax system still sees you as a collection of physical presences and legal ties. For the business owner or the shareholder of a legal entity, the danger isn't just personal income tax, it's the accidental relocation of the entire business. Welcome to Taxplained, explaining taxes so you can minimize your burden and maximize your freedom. So let's tackle the myth of legal invisibility. The search for a digital nomad tax usually stems from a complete misunderstanding of how tax residency works. Most people believe that if they spend fewer than 183 days in a country, they are safe. In reality, the 183-day rule is a fallback for most countries and not the main rule. Most countries determine residency based on your center of vital interests. If you have a long-term lease and a local gym membership and your primary laptop and business equipment in one place, a tax authority can claim you are a tax resident long before the 6-month mark. However, the bigger trap for entrepreneurs is not only their personal residency, but the residency of their business. If you own a company registered in a tax haven or a low-tax jurisdiction like Estonia or Wyoming, but you are making every strategic decision while sitting in a cafe in Lisbon or Berlin or Bali, you have effectively moved the mind and management of that company. Under the laws of most nations, a company is a tax resident where it is effectively managed. By moving yourself, you have inadvertently moved your company's tax home, possibly into a high tax jurisdiction. Then there's also the permanent establishment. If you are operating a legal entity, the most dangerous phrase in your vocabulary has to be permanent establishment. This is an international legal standard that allows a country to tax a foreign company. Traditionally, this required a physical office or a factory, and in the digital age, the definition has expanded. A permanent establishment can be triggered by a fixed place of business, which can include a desk in a co-working space if used regularly, or through what they call dependent agent. If you, as the owner or a senior representative, are habitually concluding contracts or negotiating the core terms of your business while physically present in a foreign country, that country has the right to tax the portion of the company's global profits which is attributable to your activities there. This isn't only about your salary, it's about the local government looking at your company's total revenue and demanding a slice of that corporate pie. This creates a nightmare of possible double taxation, where your country of registration and the country of physical presence both claim rights to the very same dollar. So if you are considering a move and want to know what the best path forward is, please reach out to one of our specialists for personalized assessments. Then there is the representative trap. Many business owners attempt to bypass these issues by claiming they are merely representatives of their foreign entity performing preparatory or auxiliary work. In the eyes of a tax auditor, the line between marketing and core business operations can be somewhat razor thin. If your market research involves actually delivering the service, managing a team, or billing clients, the representative shield vanishes. If you aren't a nomad visiting a market, you are a branch office operating without a license. This is especially true for Australian, European, and North American citizens whose home countries have some of the more aggressive, controlled foreign company rules. These rules are designed specifically to see through foreign shells and tax the profits at home rates if the soul of the business is still tied to the citizen. To survive as a mobile business owner, you must stop looking for loopholes and start building substance. Substance is the evidence that your company actually exists and operates in the place where it is registered. This means that you should have more than a virtual mailbox. It means having anywhere from local directors to local expenses to a local legitimate reason to be headquartered there beyond is cheaper than this tax headline rate. The goal is to align your physical movement with double taxation agreements between your home base and your host countries. These treaties are the only real protection a nomad has, as it provides a framework to decide which country gets to tax what. Without a clear understanding of these treaties, you are not a digital nomad. You are a tax evader in waiting to be caught. So, tackling the nomad tax issue requires a three-step audit. First, define where your company's mind and management truly sits. Second, evaluate if your daily activities in a host country can trigger a permanent establishment. Finally, third, ensure you are meeting the reporting requirements, like the Common Reporting Standard that now allows banks to automatically share your financial data with your home government. The era of flying under the radar ended when the world went digital. Today, the most successful nomads are not the ones hiding from the system, but the ones that have built a secure enough system to withstand it. Mobility is a privilege, but when it comes to compliance, there is a price tag. If you treat your international tax strategy as an afterthought, the Dolce Vita can turn into a legal audit nightmare. In the world of global business, clarity is now the only true tax haven.